Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boissono with my co-host Kevin Casey. And today we have Dr. Selma Hepp. Welcome, Selma. Thank you for being here today.
Thanks for having me. Pleasure to be back.
It is a joy to see you. I cannot believe it is April 1st. So today, just a little snippet from Rob Chrisman's offerings to April 1st. Turning to the markets, the economy is going to improve slowly. The economy is also going to improve fast, or vice versa. It will definitely be one or the other, and it all depends on tariffs, dampening the U.S. consumers' desire to buy anything or not, or something in between. It's just, oh my God, does that not sound like the economy, our business, like the whole thing, right? Like it could, it couldn't, maybe it will, maybe it won't. And yeah, it's just crazy. So
I think you can do the same thing with baseball. It's opening season right now, and our teams are going to be great or they're not going to be great. But
that's right. Okay, you know what is great right now is it's jobs week. That's not necessarily great. That happens very regularly, I've realized. Took me a while. ADP is coming out tomorrow. We have the reciprocal tariffs coming out tomorrow, the announcement. So we'll see what impact that has on everything. Friday is my very favorite report on baloney job numbers from the Bureau of Labor Statistics. Sorry, Selma, I don't know if you remember how much I can't stand that whole report and how flawed I think it is. But the 10-year is down to 4.16 last time I checked this morning. That is a far cry from, where was it? Like very recently, like 440 or something like that. It was on an upward trajectory, and we've enjoyed some really nice gains in the last few weeks, couple weeks, 10 days, 5 days. I'm not really clear on the timing on this. It's recent. All right. So with that being said, if you have missed any of our shows, they can be found on our YouTube channel that our friend Jason puts together for us, and also on the Chrisman Commentary website. And I don't know where else we're posted, probably on a bathroom wall somewhere. But anyway, you can go back, you can listen to them on 1.5 speed, knock it out, figure something out, learn something new. You never know what you might find on one of these. And on that note, I'd just like to give a little shout out to Kathy Grant with Guild Mortgage, who signed up for this week's show within like seconds of the flyer going out. I don't know why I was even looking at it, and it just pops up and I'm like, holy moly, that is unbelievable. So thank you. Honorable mention goes to Brian Frediani. He's with Diversified Capital. Anyway, these guys are on it. They're working late. And so thanks to everyone for being here today. We really appreciate it. So Selma, we have jobs reports coming out of our ears today. We had the JOLTS report today, and it's down like 200,000 jobs or so, this report, down from like a high of like 12 million jobs that were available. But we've learned, through the Wall Street Journal in part, that a lot of the jobs that are posted on the JOLTS report may or may not be double counted. They might be posted in different states. They might be posted with different job titles, or they might just be fake. So what are your thoughts on jobs? What's happening with them? How much credibility do you think BLS has at this point? Should we be worried about Friday? Talk to us about jobs.
Well, let's focus just on where we were expecting the job market to be at the moment. And, we were expecting the job market to slow. We were expecting the number of job openings to slow down. Remember, we, went through economic cycle high coming into 2022. And then, there was all those calls of recession. We didn't have a recession. And, the process of returning from that rebound from pandemic rebound, took longer, which is good because we didn't have a recession, we didn't have layoffs and things like that. So I think the job numbers are where they should be in essence, whether you believe exact numbers or not, but I think the economy is where we sort of expected it to be in terms of cycles, and so we are now entering a slower cycle. We knew that was going to happen, just simply where we are with the economy. So we're entering the slower cycle, so we'll see fewer job creations. We'll see fewer job openings. Remember, the Fed was really, one of their main pain point was that job openings rate, because it was so it looked like the numbers were so elevated, so it was putting pressure on wages, which was, leading to higher inflation. So the fact that it's normalizing, it's good, at least in terms of, reeling in the inflation part that's driven by wages, so yeah, I think we are where we thought we were going to be, I mean, set aside all the layoffs we're talking about otherwise, but that's not yet reflected in unemployment data. Where we are in terms of unemployment data today is where we thought we would be.
That's good to know that. I mean, and again, we talk about this regularly, that recessions are cyclical. The economy runs in cycles. These are normal things. I didn't realize that these job numbers are what they were expected to be. So that is good news. And my gripe with BLS, as we know, is that I'm not a big fan of the idea that having some data that's flawed is better than having old data that's real. I know that's not necessarily what's accepted in economic circles, but it doesn't make sense to me. So maybe walk us through why economists think that idea that makes sense. The markets are so moved by things like BLS and job numbers and inflation numbers, and then we get these massive revisions later that impact the market. So how do we wrap our brain around that? Is there any fix for it, do you think? And should we even be?
Well, yeah, no, I think that's why we look at number of data point, number of employment. So you have the ADP report, you have the, Indeed data, ZipRecruiter, everybody puts out some level of employment numbers or of job creations and things like that. The thing is that, as with any data point, it's not a complete coverage. So, and especially the big issue with some of these data points that have huge revisions is that they are samples. They're samples and they're not big samples. And so sometimes you have the bias of people not wanting to respond to them, or people, well, yeah, I mean, the biggest bias, is that fewer and fewer people are willing to respond to surveys. And then if you have a certain type of population responding to surveys, say generation like older people, you'll get another type of bias, and so that is inherently in survey data. You will see that in any type of data point that that depends on small samples, so because of that, I just always look at multiple data points, and I think that that's I don't know why the markets get so moved by that one data point, but I think in genuinely they do look at multiple data points. I don't know what it is about certain data points that move them more than others. I think also, the markets nowadays are moved a lot by, high frequency trading and like sort of computerized trades. And so you get momentum going and it overshoots or, or undershoots. And so sometimes I think the volatility itself is just simply the fact that everything is so, computerized, I guess, or not digital. What's the word I'm looking for? It's based on momentums in the data.
Yeah, it creates some velocity and it just sort of off on its
I mean,
own.
I like to look at the trends more than the numbers.
Yeah, exactly.
Is it trending up or is it trending down? And every so often, any data number, there's always a spike either up or down, but then you see the overall trend is going one direction.
Yeah.
Then I follow that overall trend. And usually if you see the trend starting to either bottom or crest, and now what's it doing? That's more value than an individual number.
Yeah, absolutely. I agree with you.
Yeah.
And
And
I haven't learned that over time, just especially since we had COVID in the middle of all this, where everything now is okay versus pre-pandemic, and remembering to look back, not just 3 years or 4 years or 5 years when we are in the middle of, this event, but look back farther than that, where it was a more, whatever you want to call, normal market.
Yeah,
I like to actually, when I'm looking at trends that are like 10-year trend, I tend to put a blank spot where COVID was. So 2020 to 2024, just make that blank and then pretend the numbers, you can kind of see where they should be going. And are they back to where they were going before? or
Mhm.
are they going in a different direction? And all the numbers I've seen to say is they've kind of like picked back up again, where like as if COVID never happened. And now we seem to be back on track on a lot of the numbers that I'm seeing out there, whether it's jobs or, stock market, everything seems to be kind of going back to a normal,
Yeah,
as much
yeah,
normal as we can be.
yeah, absolutely.
So Selma, let's talk for a moment about the sign behind your shoulder that says Cotality, where it
Yes.
say CoreLogic. Can you walk us through CoreLogic versus Cotality and how that is that going to have any impact on what you actually do, or is it just a name change? Talk about it. Talk about that.
Well, the name change is just a name change. Nothing changes here on out. But what has changed over the course of last 5 years at least, and even longer, since CoreLogic was started as a company, is that we've evolved from being just mortgage intelligence company to having like an entire 360-degree view of a property. And so we have so many data points now that speak on everything about the property, including, new construction permits, MLS listings, liens, property records data, insurance information, property characteristics that feed into insurance information. So we are so much more than we used to be, and the new name reflects that. And so to give you, the idea of why the name as it is it's Cotality is sort of a nudge to our CoreLogic, but it also speaks to collaboration. We like to mention how much we try to be partners with our clients, and so that that's collaboration. And then you have Totality, which speaks to the 360-degree view of the property ecosystem, and then also Vitality, the idea that we've invested so much in innovation, AI, and solutions that are more advanced than they ever used to be. And so that's what the Cotality stands for, and that's the reason for rebranding.
All right, got it. And how do you choose what your focus, like from your perspective? You're the chief economist. How do you decide what you're going to study? What is important? How you look at things? How do you make those decisions? Is it yearly? Is it annually? Is it all the time on the fly? Is it ever changing?
Oh
How do
yeah, it's changing. It's on the fly a lot of times. We have major topics that we would like to look at over the course of a year, and those do change. But on a day-to-day basis, oftentimes it's an ad hoc request. It's something that's currently going on in the market that needs to that does impact housing market trends that we look at. So, there's no rhyme and reason in many ways. It's more just what the needs are, and so at the moment, I don't know, tariffs, for example, how do tariffs impact the housing market, or what mortgage rates, we always look at mortgage rates, how that's impacting the housing market, what are inventory trends. So, there's some overarching themes, and then within these themes, we look at maybe more current trends.
well, let's talk about the tariffs since they're going into effect tomorrow, presumably. And how it's going to
I
work.
give that 50-50.
50-50.
Yeah.
Okay.
There also, there's reciprocal tariffs are going to be announced tomorrow as well. So can you walk us through your thoughts on the tariffs, on the reciprocal tariffs, and their impact on, everything?
Yeah. Well, so we don't know, as you guys noted, exactly what is going to happen, and that's the problem for for forecasters, or even people trying to plan for their business. Is it's difficult to predict what's going to happen. So, but based on some information that is out there available on the construction costs, construction material costs, and how those are going to impact. We did do an estimate that showed about a 10% increase in material prices over the next 12-month period. And majority of the impact on residential construction, in fact, comes from price-wise, it's from appliances. Appliances are going to be the ones impacted the most, and they're driving the biggest increase in actual dollar cost of construction, which, currently median cost of new home is $422,000. You add about $22,000 to that, and you get about $450,000 in terms of new construction costs. Now, again, 10% is cumulative of inflation as well, because we do predict 3% inflation, and then actual tariffs drive prices by 4 to 6%. So that adds up to 10%. But the other thing is, the bigger impact is actually on commercial construction because of the cement and steel tariffs, and so the cost is going to be much larger in commercial.
Steel is coming from China.
Yeah, steel is coming from China.
And
And in terms of lumber products in the US, we've already gone sort of through this exercise a little bit last time around during the first administration. And some of the production has already shifted to places in like Oregon and Washington state, as well in states in the South. So we already source more lumber locally than we did, say, a few years ago. So not as big of a, and hopefully not as much volatility in lumber prices as we've seen, especially at the onset of the pandemic, but also in that period right before. So that's kind of where we are in terms of.
And I notice it myself as almost most of my clients now that for loans, the inquiries are for construction loans. And I've never had so many. And it's like, wow, it's a large percentage of my business now. It's, sometimes it's after the work, sometimes this is going to start the work, various phases of the construction, but they're all construction related. But that's why they need the cash, or that's why they are doing the loan entirely. So it's kind of interesting that they don't care whether there's tariffs are coming. They're planning construction.
So
Jerome Powell used the word transitory, as well as a couple of other Fed members, which gave some of us the heebie-jeebies as we reckon back to when they used that word last time with regard to inflation. And so your thoughts on whether or not this tariff impact will be transitory, or whether it will be more of a long-term effect? Because I think you said that you calculate a certain percentage over the next year, which is not necessarily. So talk to us about that a little bit, please.
Yeah, so I mean, economic theory would suggest that when you have a one-time shock, it's a transitory impact. But I'm a little bit, as you, I'm a little bit more, concerned about the transitory part, simply because, so to give you like a real life example, I'm buying appliance, I'm buying a washer and dryer for my house. And I go in, early March or maybe February, get a price. A week later, I go to buy that same appliance, and it's now, $200 more for each unit.
Each unit.
So, businesses are already pricing in, a lot of this, to preserve their margins for one, and, and just because of uncertainty, they have to start building in these costs. And so you have one business that affects the cost of the next business, that impacts the cost of next business. And so in my opinion, the transitory is, I'm not on board that it's all transitory. I mean, if it was all transitory, I'm just not on board that it's all transitory.
Well, because if they keep increasing the tariffs, tit for tat, tit for tat, tit for tat.
Well, that too. So then
that's
you
not
have
transitory. That's just elevates world,
Yeah, exactly. So going back to the retaliation part is, you then get tit for tat and more inflation down the road. So I mean,
all I care about is my tariffs on maple syrup and avocados. I mean, that's my.
There you go. Which I think, they've already been impacted. The price of produce
Mhm.
too has already been impacted. So, I mean, yeah, it's a dangerous game to play. I mean, 99% of economists will tell you that's not a right way to go. To use tariffs to achieve and I don't even know what we're achieving right now, but tariffs are not a good policy.
So one of I think it was the Commerce Secretary was saying that they really think that the income from tariffs is going to help them pay down the debt. They're really looking for that income. And so over the last month or two, we've heard varying reasons for having the tariffs. And one of them was to compel our neighbors to the north and south to take part in the war on drugs and to keep people from coming over the border, et cetera, et cetera. But that seems to have shifted a little bit now to these tariffs are not they're going to be here to stay. They want that income. And I mean, if the Commerce Secretary is, don't quote me on that, I'm pretty darn sure that's who it was, is indicating that that is the reason, it makes it feel like it's much stickier and less transitory and something that we're going to have to deal with in the long term versus the short term. So it'll be interesting to see how it all plays out. But overall, we just need to keep our focus on how does that impact our consumers? How does it impact their jobs, their ability to qualify for a mortgage, their desire to own a house, et cetera. So that part is going to be interesting. And we had PCE come out last week, which is the Fed's favorite measure of inflation, and it was up. It was up, but the core, what was most concerning is the 3 to 6 month run rates are going up, not down, and are well above the Fed's target of 2% core. So what are and also the replacements in the next, after this month, the replacements going forward for the rest of the year are really low. It's going to be hard to make progress on that core CPI or PCE number. I mean, what is the Fed going to do with all this? And then in light of whatever happens with the jobs report on Friday, where they're expecting the unemployment rate to tick from 4.1 to 4.2 and maybe, depending on the rounding, 4.3. So at what point are they in a tough spot, right? Because, if the growth is slowing, consumers are not spending as much. And yeah, we're in a really strange place right now.
Yeah. Well, in my opinion, they are already in a tough spot because, they were in a monetary loosening cycle until this all came along, and now they're projecting higher inflation. They don't project the 2% target until 2027. In fact, reacceleration in inflation. They do expect a higher rate of unemployment, both of which suggest lower growth, and so you end up with stagflation, or even recession. I mean, the risks of recession have grown considerably over the last month because of all of this, especially because of the pullback in consumer sentiment and consumer spending. So, I think we're looking at, a different economy. But ironically, maybe all of this would help mortgage rates down the road, because if you have a higher level of unemployment, if you have maybe a recession, even the Fed, objectives changes, and always, we keep in mind that the two mandates are maximum employment, not unemployment, and price stability, right? And so you have a runoff in price stability, you have a runoff in a rate of unemployment, so it just changes the way they look at what their next step is. And so I don't know what our projections were for no rate cuts for this year, no more rate cuts this year.
Really? None at all?
No, because of the reacceleration in inflation, mostly. But now with a higher unemployment rate, which, like you said at the beginning, Audrey, is, are we really measuring something current, or are we measuring something that happened maybe 6 months ago? Unemployment data is lagging, right? And so all of these layoffs won't be captured in the data until at the end of this year, probably. And so So, at that point, we could be already in a recession, and Fed, people always accuse of Fed coming to the party too late. So understanding that we're in a recession too late and doing something a little too late, which then, sort of neutralizes whatever they're trying to do. Huh.
Say, since until you're in a recession half the time until you're out of it, because
Yeah.
is one of the indicators, right? It is tough. I mean, they're in a tough spot. I don't envy them their job one bit. But then we
Oh,
have
but you take him in a heartbeat.
what?
If Trump called you and asked you to be Fed chair, would you take that job?
Oh God, you're welcome, everyone. No, I would not.
How about Selma? Would you take
No,
that job?
no, I would
Sure.
not.
I'd
Yeah,
take it in a heartbeat.
you would.
Oh
Good
yeah.
for you.
Running the CA, but I
He
definitely
just gives canned speeches all the time. He just changes a word here and there. It's good. It's a simple job.
delusion that I'm
Just,
qualified for that. So that's
just
good.
like that California insurance commissioner. It's the easiest job in the world. He gets to travel all the time.
Oh my gosh. So it was funny. So I think I've talked about the fact that I've been like I've been in touch with this office about getting him on here. I interviewed him last August in Newport Beach, and then Kevin sent me an article the other day about his travels and his penchant for liking to go to conferences in wonderful places, etc. So
By
maybe
the way, but always at the time when he was supposed to be presenting to the Senate. We're talking about the insurance commissioner in California here.
yes.
Oh,
Oh, yeah. Okay, so with all that being said, so we do have consumer confidence that has suffered. It's the University of Michigan survey just came out, and the consumer confidence numbers that they published went from 65 to 57. Consumers are not feeling good about their jobs. They're not feeling good about, like, the quits rate is lower. Just people aren't so confident that once they don't have a job, they're going to be able to get another one. And so with all of that, we have to remember, and again, with the Fed, like, okay, usually if things are burning up, then they raise rates. If they're doing terribly, they lower rates, and it stimulates the economy. Now we're in a situation where, okay, things are not growing. We don't have, the employment is questionable. We'll see how that goes. And then we have it's all very stagnant in a lot of ways, right? So what do they do going forward? Well, look at the last couple of weeks. It's been really interesting to watch mortgage rates respond to what is going on out there. So the less uncertainty we could have, the better off we'd be. I think we can all agree on that, right?
mhm.
And other than that, why would we want to encourage our buyers to buy a house right now, right? And so, Selma, what happens in recessions with housing typically? I mean, unless we cause it, of course.
Right. Well, so it depends if the recession is followed by high rate of unemployment. If you just have a recession that's a loss of confidence and people spend less, but they, generally the unemployment rate doesn't go up, doesn't spike up. Because, when you think about recession and how it impacted housing market, first thought is a great financial crisis. And, the surge in unemployment rate, like I think was up to 8-9%. And even at the onset of the pandemic, but that was a different type of recession. Not having a job is much different than having a job and just spending less, And so if people are still employed, it's not going to have as detrimental impact on the housing market as if they're not employed. Because if they're not employed, then they are forced to potentially put their home on the market. You have a surge in supply, not as much demand, and home prices decline, right? But if you can stick it out in your house, and you don't have to sell it, you don't have that supply impact. So, and that's kind of what we're looking at the moment for housing market for this year, is that, we do see a lot of supply coming on, especially in California markets relative to previous, few years. So you have some normalization in terms of supply, which is holding price appreciation sort of steady. So not as much as a price appreciation, but more home sales activity. So, hopefully that remains, without some significant unemployment shock, right? I don't know if I answered your question, but
Yeah, no, I like that.
Okay. good Lord. I don't know how Cotality feels about this, but CoreLogic recently revised their estimates for appreciation up slightly for the year. So that I thought that was interesting, and I think you were right, by the way. Like it because it's more in line with a lot of the other projections out there right now for home price appreciation nationally. So
Yeah. Yeah, so this is, when you look at the year-over-year price changes and forecasts, you always have to think about what happened in the base year. What are you comparing the numbers with? The reason for revision is that we had such slow home price appreciation in second half of 2024. It was essentially flat and well below what sort of seasonal trends have shown in any market prior to the pandemic. Well, pandemic, of course, that we are blanking out that, as you said, that period. But so we're comparing to pre-pandemic, but it was really slow. And so you have a slight boost in home price appreciation in spring home buying season. That automatically raises that level so that on a year-over-year basis, you have a higher number. So it's really about that than no, we're going to see a surge in appreciation. It's not the same thing, you know?
well, and I mean, I think for those of us who've been around since dinosaurs walked the earth, we don't want to see 15, 20%, 30,
No,
30%.
especially now. I mean, it's already so unaffordable. Yeah.
I'm so
Yeah.
happy with 4% appreciation. And on that note, again, I keep talking about this because I think it's important that we convey this to our clients when we're talking about affordability. Yes, it's not inexpensive to buy a house. That is a given for a myriad of reasons. But it is also very expensive to do Uber Eats every night of the week and to have a car payment of $800 or $1,000 a month, sometimes times two. And so there are a lot of parts of our lives that had become more normalized as we see what everyone else has on social media versus just doubling down and thinking, I'm going to think about my future. I'm going to think about future appreciation. I'm going to think about not paying for somebody else's property when I'm renting it to have future
No,
appreciation.
that's okay for them to do that if they're renting my property.
Right, exactly. Well, that's a good, absolutely, we give Kevin a carve out on that. But with all that being said, there are some things that people are doing right now which are actually making their lives more unaffordable. And then we also have the student loan situation that is really coming into play again. We have 9.7 million people who are delinquent on their student loans. I mean, that's a huge
Wait,
number.
what are they going through?
They're, huh?
I didn't hear what you said. 9.7 million people what?
Delinquent, past due on their student.
Delinquent.
Yes. So think about this when you're thinking about your clients. Think about your parents that you did a refinance for or did a purchase for who have student loan debt for their kids on their credit reports. I've had that. Think about the ways that you can go and help your borrowers and talk to your clients about things that you've seen in the past that may be impacting them now. So, for 3.5 years, we've had either a moratorium on student loan payments or or even when you were supposed to start making your payments, it still wasn't going to impact your credit. That's over. And so,
As of today, I believe, isn't it?
is it today?
I think it is, yeah.
Anyway, so that's going to be, I mean, again, 9.7 million past due student loan borrowers is not a little number. And it's going to have some impact on things, right? Whether it's consumer spending or maybe they will have Uber.
But you know what else it's going to do? So all these payments that have been deferred are now suddenly due again. And so a lot of people are going to get a surprise, like, wait a minute, my payment has gone up. I used to be paying $200 a month, and now suddenly I have to pay $400 a month because I've not paid for 3 years, whatever the number is. And so that is going to do two things. Number one, it's going to slow the economy down because people are going to have that discretionary money coming out, and I got to figure out how to come up with another $200 a month. But the other thing they're going to do is it's going to drive people to go get better jobs, which it actually stimulates the economy because they need to make more money to make their student loan payment. So they're going to be more aggressive about finding a better paying job. So it's kind of the market works it out sometimes.
Do this better jobs exist? And especially if you look at like the U6 unemployment number, which is more like an 8% unemployment rate, and the fact that the fastest growing segment within the jobs report of job creations last time around was 16 to 19-year-olds. So let's assume those aren't full-time, high-paying jobs. And so what kind of jobs are available? So I don't know, Selma, what are your thoughts on all this? Is
In-N-Out Burgers paying $21 an hour.
what?
Yeah.
What? Say that again?
I said In-N-Out Burgers paying $21 an hour.
No, is that their current rate? Because they've been paying over
That's
20
what it says on the door.
time in my
Pay
neighborhood.
$21 an hour starting. I'm like, wow,
Could be
that's more than, an office clerk at an insurance company making.
Selma, thoughts?
Well, there's so much to talk about there. Well, one thing about, you mentioned a long-term unemployed, we do see in the data that people that have been unemployed for a long time are having harder time finding a job. So it's really that's the concerning part, is when you have long-term unemployed not being able to find a job. And so, of all of this, that's the most concerning stat to me, is the long-term unemployed. But whenever there is a shock, economic hardship shock, people pull back. So whether that's be student loans, whether that be anything else, people will be pulling back. And we're already seeing that in the even credit card spending. So if you one interesting report is from Visa consumer spending report, that's pulled back a lot. And so when you think about how recessions happen, you have loss of confidence in addition to some economic shock, and very quickly you see decline in economic activity on a quarterly basis, which 2 in a row you have a recession. So yeah, I mean it's
Are you saying credit card debt is not rising right now?
No, what I'm saying is that people are pulling back on spending with credit cards, and even higher income, because higher income households have been sort of the main driver of the increase in spending, credit card spending, and they've pulled back. So everybody's pulling back, and when higher income households are pulling back, something is on their mind.
Yeah.
Yeah.
They published their weekly mortgage applications. Purchases were up 1% week over week, 7% year over year. Refis were down 5% week over week, but up 63% year over year. And I want to clarify this because last week I feel like I tripped over my words and wasn't completely clear. So refis are 40% of all applications right now. And the cash out component of refinances are 28% of the business, 70% of refis. So if you have still not gotten off the idea that people are not getting, not doing loans because they're stuck in a low rate, yes, a lot of them are still in low rates, and a lot of them still don't want to move off of that. But some of them do. And the more that you can really work with them and use real numbers, because you ask someone what their mortgage rate is, they are pretty darn sure that it's, 1 3/4. But if you ask them what they're paying on their credit card, their car, their whatever, they have no idea.
29.995.
I'm like, I know what my interest rate on my car is because it's 1.95%, which I keep in my head because I don't, it doesn't make any sense to disrupt that, right? So, but if my car interest rate was 18%, I would want to know that. And I've seen that. So people don't know what they're paying. They don't know what the overall blended rate of their payments and their interest rates are. So it is something to look at and take a dive in. And again, we're always looking for ways that we can be a professional. How can you guide your borrowers, your referral sources? I mean, I had a really interesting conversation yesterday with a new realtor. And the beautiful thing about a new realtor, because I told her, I said, normally when somebody says, oh, I'm going to get my real estate license, I cringe. I try to keep the look off my face and I think, oh God, here we go again, right? But this person is going to be great. Like she's one of those people. She'll be an asset. But also what's really good about her is she doesn't have all the baggage that we all have, right? So she's not waiting for rates to come down. She doesn't remember how it used to be. She doesn't have any of that. And so the more we can shed that and just, okay, we're in the present moment. This is what we have to work with. Let's work with it. The better off we are. But, again, how are we a professional? How can we outshine a call center somewhere? And there are a million different ways. And one of them is run the numbers, have people get their statements out and look and see what their interest rates are on all of their other debt. And to Kevin's point, the student loans, that is something to look at too, because some of that student loan debt, those are at very high interest rates as well. Maybe you can consolidate it. And if somebody says, oh, if I
You
work,
do you can do a student loan refi, actually. There's a special loan program for that.
right. So the other part of it too is I have this come up previously, where I had somebody who was hanging on to their student loan debt because they had quit their tech job and gone back to school, gotten a master's degree, spent, way more than it was definitely more than it was worth, gone to work at a nonprofit with the idea that my student loan debt is going to be forgiven once I work at this nonprofit for 10 years. And I said, do you have that in writing? She said, no. I said, can you call your company and ask them, like the servicing?
Confirm. This is great, by the way. Keep going.
No, I mean, she said yes. So she did. It was very, very, very hard to get someone on the phone, get them to look at the terms. Bottom line was her husband still worked in tech and made a lot of money. So guess what? At the end of that 10 years, they were going to look at the household income at that point, and based on their household income, she was not qualifying for forgiveness at all. So people don't know the terms of their debt at all, other than their mortgage, what they think they know. Maybe they do, maybe they don't. So
So
again,
did you advise her to ditch her husband?
yeah, yeah, because divorce
That's the solution. She just get rid of him
is a great
because
idea.
he's making too much money. You don't want that.
Right,
And yeah, she
right.
should be poor, and then she'll get all her student loan forgiven, and then she'll be a happy woman.
Yeah, but your clients are so lucky. Thank God they get that kind of solid.
Solid advice. I do it all the time. Yeah. Good advice like that. Yeah.
Oh my God. Okay, so I cannot say this enough, I don't think. So as we are watching rates go down, thank God. I mean, I like it just as much as anyone else. Selma, you don't know this, but I don't care anymore. I'm like, I'll look someone in the eye and go, yep, that'll be 10.5% and 2 points on that private money loan. And I don't even blink, because if it makes sense for them, it's a good thing, right? So, which is far cry from what I used to be. I used to be so hyper focused on, oh my God, the eight, the eight, the eight. So anyway, but I do like it when they come down. So I just want to be clear about that. But we have two things that become issues during this period of time as rates are coming down. Number one, your client locks their rate, and they certainly want to be protected from any rate increases, but they are very interested in any sort of advantage they might get when the rates go down. So make sure that you're in touch with your AEs, you understand the rate renegotiation policies of the companies where you have your loans, and figure out what your strategy is going to be for clients, and thinking about pull-through rates, et cetera, all those things, while keeping your clients. The other thing too is EPOs. So if you are refinancing someone, or it doesn't even matter, if you're doing a loan for someone and you lock in their rate now and they close, and then all of a sudden the rates plunge, and even if they don't plunge, some people will refinance for an eighth better.
Uh-huh.
Now is the time to keep in touch with your borrowers that you've closed in the last 6 months, and also read your wholesale agreements to see, because some lenders, it's a 12-month EPO, not 6 months.
Yeah,
And
avoid those 12-month ones.
And so you just have to be thinking about how you're going to handle this, and make sure that you're protecting yourself. So
And some it's 6 months from the close date, and others it's 6 mortgage payments.
yes, right. And some of it's from the note date, like they're all a little different. So thank you, Kevin. So
I've been burned on a couple of them, so.
yeah. Okay, so I thought it was interesting to know, we've all talked about trigger leads a lot. Trigger leads, when you run your client's credit and then they get 970,000
Yep.
pings from
Oh,
some.
I told you a story about I helped a client go on the opt-out pre-screen, did all that stuff so they wouldn't get any calls, and he still got someone soliciting them. So you advised that I report that guy.
Good.
I still have to find out how to do this. If anybody watching knows how to report one of these guys, I would love to turn him in, because, hey, he's violating the law. He's calling someone who's on the no-call list, and I just don't know how to have them reported.
Okay. If I may, did I not suggest that you go on the opt-out website and see how to report someone? Did you?
I never seen that site. I mean, I've seen the opt-out website, but I've not seen where you can report somebody.
Okay, I suggest you look there first, and then I bet we could Google that and figure it out. Okay, so
I think I'd rather just have the audience tell me where to go.
I'll
What's the opt-out website?
tell you where to go. All right.
Yeah. No, I'm serious. What is the opt-out website? Because I need to put my numbers in.
Screen.com, and that will make it so that it's at least they're not supposed to contact you without your permission for 5 years.
So
So
optoutprescreen.com.
Prescreen.com. I got it. Okay.
And then you have to be careful because the site naturally tries to opt you in. So you have to make sure you hit the opt out and you do the 5-year opt out
Okay.
for internet access. And then you go on to the next step, put your name and address, social security number in there, and then
Okay.
submit it. And then just have to remember to renew it every 5 years.
Okay.
okay,
Good to know.
back to my original point, which was that, are you ready for this? So we know that NBA has dropped trigger lead legislation in Congress. NAM has done it multiple times, way more than anyone else. We have another organization who took credit for it, but hadn't done much. And still nothing happened at a federal level. Guess who has enacted trigger lead legislation? It's not California. You're not gonna believe this.
Arkansas.
Idaho.
Idaho, yay to go, leading state.
I mean, it used to be California. Are we losing our touch? Anyway, so that is interesting that finally, but now there's finally a foothold because some states maintain that, that they can't do it, that it's illegal, anyway. So I thought that was really, really great. So congratulations to Idaho and anyone who lives there who doesn't need to be bothered by 5 million people contacting them. Selma, we have a friend whose client went to the ER with an anxiety attack after receiving 100 plus texts, phone calls, emails over the course of a very short amount of time. Like, it's crazy. So, and Kevin, Tina put in the into the chat 888-382-1222. Yeah, I didn't think it was going to be, Tina, not to minimize this at all, but I didn't think it was that hard to figure out how to file a complaint on that. Anyway, with all that being said.
With all that being said, we have input from Tina Broyles, and she gave me the FTC's Federal Trade Commission's complaint department. And that's where you complained about an opt-out.
I want you to go back and listen to this recording. And
I didn't hear a word you said, Audrey. I don't listen to anything you say, remember? I don't know why you don't listen to me when I say I don't listen to you.
Oh my God. People give me a hard time. Okay. Occasionally someone will say, oh, you need to be so nice to him. And I'm like, I am nice to him, but what do you
see, I was busy pulling this site up and it's great. It's like, boom, it's right there. And I just love it because it's like, I had walked this guy through the whole thing. Yeah, you shouldn't get any calls or any solicitations. And sure enough, bingo bango, this one loan officer started targeting him. And I'm like, but he sent me his information, which was great. And I looked him up, brand new in the business. I'm like, okay, let's spank that boy. Don't be doing that stuff.
when you hear this bit. So keep going on that. Okay, so there was an article by Logan. Oh my God, I'm gonna have to practice saying his name because he's coming on our show soon. You know him, Selma, I bet.
Yeah, Mogashani. Yeah.
Look, say it again.
I think I'm gonna butcher it. So it starts with M. Mogashani, I think. Mogashani.
Montashami. Anyway,
Yeah.
Great guy. He'll be on here not too long. He wrote this article for Housing Wire about how, and the title was "No, homeowner delinquency rates aren't elevated." And aside from FHA, which we know is having its issues, talking about how there isn't elevated homeowner delinquencies, that the delinquency rates are still under 1%, that there was a confusion around a Freddie Mac report that talked about serious delinquencies, but it was on their multifamily loans, not on single family loans. And that some people kind of took that and ran off the cliff with it. And we've heard that narrative from people as well, where they're like, oh my God, delinquencies are up. And oh my God, there's going to be the bubble, it's going to burst and all this stuff, which thoughts? What are your thoughts on?
Yeah, no, I hear that all the time too. No, I mean, Cotality data is at some of the lowest levels ever. So for those loans that are in foreclosure, it's only down to 0.3%, which is the lowest since going back to Great Financial Crisis. And even for serious delinquencies is below 1%, like you said. I think the narrative came from the fear that some of the foreclosure moratoria was ending, and also forbearance periods were ending, and that all these people that were in these programs, that they were going to all default. But there are a couple of things, first, they've been seriously modified and remodified to make their mortgage payment more affordable. Hopefully that, and that's worked for a number of people. The other thing is people have a lot of equity these days. So in the worst case scenario, if they're like, okay, I can't afford this home, they're more likely to sell it and still walk away with some cash than go into foreclosure. So really, we don't see foreclosure, any sort of looming foreclosure crisis, and I just don't know. So I don't know what the precipice for that narrative was, other than just ending of some of these programs that we worry that may lead to more foreclosures, but are really not.
Yeah, I mean, everything we're seeing says the same thing. And I think there is a segment of people, the media, whatever, who really likes that negative narrative, and they're forecasting doom and gloom, and it doesn't help anyone. It keeps people from getting a new home, or a home, I don't mean new, getting a home, creating future wealth, making sure that they know what their payments are approximately for, the foreseeable future. So it's really important that we understand that what's real, so that we can convey that to our clients, our referral partners, etc. Okay, so the FHFA, and this came up last week on our show, because there was this rumor that FHFA, Bill Pulte, is now in charge, and they were making huge changes, that they changed the board structures, they fired people, it's really something else over there. But one of the things that people were saying is that they were going to lower the loan limits on conforming loans. And literally, like within minutes of our show ending last week, I got something that said that is not happening. So that's something that's good. And also there's some clarification around some of the other things that have been talked about. One of them is that they are pulling back on the special purpose credit programs, right? So people thought that meant, and I was among them, because you just think, okay, well, that must be everything. It's not. So this is some good news. Ready?
So we still have home ready, home possible?
So LIP, low income, VLIP, very low income. Selma, I can't even tell you the amount of laughter that we had over those acronyms. But anyway, possible, home ready, those are all still intact. Okay. They did pull back some renter protections, but they were tied to the GSE's multifamily properties and not to single families. And again, these are regulated at other levels of either government, etc. And then there is this conversation around UDAP being completely gotten rid of. Well, there's oversight there from other agencies. So they repealed their climate risk guidance, but their thought was GSEs aren't supposed to be climate think tank. So anyway, we'll see how it all rolls out, but it wasn't quite what we thought, which is great news. Thank God. So there is another change though with FHA and non-present, say that 3 times fast. No, non-permanent residents are no longer going to be eligible for an FHA loan for case numbers that are pulled after May 24th, 2025. So be aware of that. Case number is the date that's pulled. That's the cutoff. And so again, how do we work with that? How do you work around that? What other programs are available? There are other programs available, maybe not with 3%, 3.5% down, but we'll see how it all works out, right? So let's take our last few minutes together and talk about some of the things that Cotality is doing around, we get very caught up in mortgage rates and the rates, and we have things like insurance and climate change impacting insurance rates and sea level rise and a few other
Mhm.
things. So what's going on with you and your focus and what impact it has on mortgages and real
Oh
estate?
yeah, no. So irrespective how you feel about climate change as a terminology, there's risks to properties, right? There's natural risks that are happening more frequently and that they're more costly. I mean, we've seen the LA wildfire is one of the costliest event that has happened. And people are losing everything. They're losing all their equity. They're losing everything, and so that have to be taken seriously. So we're spending a lot of time on sort of understanding the risk at the property level versus some bigger geography where you group everybody together and say, okay, they're all at the same risk, whereas they're not. There's so many things that impact the risk. There's elevation of first floor in Florida, for example, or how much shrub you have around you in wildfire prone areas, or is your roof fire resistant and things like that. So we take each characteristic of a property into account and risk score it, to see what the probability is that something would happen, and then what the reconstruction value would be. And so the other thing we've sort of turned our focus to is looking at mitigation efforts, like what can be done, and let's create some sort of mitigation score for each property so that people know how they can protect themselves as well as not have insane insurance bills. And which really at the end of it, when I think about the risks in the housing market, we talk about foreclosures, we talk about unemployment, but when you have a natural disaster and you don't have insurance, forget it, you're done.
Yep.
And so that's my biggest worry is, where are we in terms of insurance costs for especially for people who can't afford it or who drop it. You're now own your home free and clear, you've paid it off, and now you don't have to have insurance because nobody's hanging over you asking you for insurance, and so you drop it, and what happens? So those are the type of things that we're trying to educate on and just prepare people, and so yeah.
Yeah.
I had an interesting conversation. I was ordering a new front door from Home Depot, and they were saying that they had all these new doors that were supposed to have arrived, but all got diverted to Los Angeles. So it was like that was really interesting.
Yeah.
Um, and then I said, but that's really quick. How are they building their houses so quick? And it's like, well, a lot of people in Los Angeles actually don't even have insurance. They just self-insured. They had the cash, and they're the ones who are already in the process of rebuilding. So it's quite
Yeah.
interesting.
Yeah, but so going back to our beginning of the conversation about inflation, think about how inflationary these type of events are too. How much more does it cost for new construction now in LA because of all the homes that have been destroyed?
Yeah.
A colleague of ours said that in his area, which is Pacific Palisades, the cost is now up to $1,000 per square foot. Just before the fires, we're talking about $400 per square foot to build a home. But you have to clean up your land. You have to
Yep.
do so much to prepare for reconstruction. So, anyways, I mean, talking about things that are impacting inflation, it's not just it's so many things, but not least of which is natural disasters.
Right. And again, don't forget that it isn't just wildfires, it isn't just tornadoes or cyclones or whatever. Look what just happened in the Midwest. And
Yes.
so, and we were listening to this insurance guy recently, and he was saying that Oklahoma has the highest insurance in the country. And so
Really?
it is really interesting that some of the things that we have as preconceived notions are not necessarily true. So,
Yeah.
all that being said, as always, we have a lot to think about. There's never enough time for all of this, and we thank you from the bottom of our hearts for being here, Selma. We always really enjoy it and are grateful that you come and share with us. So thank you very, very much. Good luck.
Thank you.
Cotality. I'm embracing the name completely now.
Okay, thank you. And thanks so much for having me. It's always a pleasure to chat with you guys. You're a hoot. I love being on the show with you.
So, and
Thanks, Selma.
the chat they're asking if the IRS is going to increase the capital gains exemption, and it's being considered. I mean, along with everything else. So, just
Yeah.
summarize, who the heck knows?
Who knows?
Oh, wait, there's a 50% chance I will and a 50% chance I won't.
Thank you,
Exactly. Exactly.
Thank you. That's great.
Got the odds there. You can
Yeah.
bet either way or both.
Yeah.
Back to Rob Chrisman's capital markets wrap up in his April Fool's edition. So with all that, there are loans to close. There are people who need place to live. There's debt that needs to be consolidated. Go get it. Go help someone. So have a great week, everyone.